since I kind of got into currency trading. And so we're going to have a closer look at automating a supply and demand strategy. And we'll kind of get into a little of the details of how this is done. And then we're going to have a look at a prototype that I've written that's been running for about 2 weeks or so. And we'll kind of look at the results and some of the trades. So an overview quickly, very briefly, who I am, my motivation for the project. So we're going to talk about the rules, some of the things that the project had to enforce to be valid for me. Then we're going to be looking at quantifying the most simple rules, because I mean the supply and demand method that we use at Pipnotic it's not complicated, but there are kind of series of qualification rules that we have, and so I just wanted to focus on the most simple. The reason I did this is ultimately to make it easy to program. Then we're going to have a quick look at early impressions and some results, and then have a look at the to-dos, something that we could perhaps consider to implement that may in some way enhance the performance of this robot. Okay, so who am I? My name is Sareed Harper. Most of you won't know who I am, just a kind of a computer guy. I've been doing IT security for about the past 15 years, and my specialty is vulnerability analysis. So we would typically get hired by the banks. We'd have to hack into the banks and tell them how we got in, and ultimately how you prevent such vulnerabilities from being exploited in the future. Then I got into malware, which was really exciting. So analyzing computer viruses. And this was a very exciting task. And so ultimately I spent most of my time sitting in banks, which is how I was introduced to trading. And now I'm at Pipnotic, which opened in about 2010, and I do all the software development there. So it's just me. So the Christmas parties are a bit boring, but you get to work at home, which is great. Okay, let's have a look at the project motivation. So my motivation to write this utility, or this automated trading robot, is I wanted to validate effective configurations for my discretionary tools. So if we have a quick look here, you can see that I've put on the right side, I have this discretionary tools that are running. On the left side, I have the robot. And so I wanted to try and validate some of the parameters in my discretionary tools. And if we look, let's grab this over here and have a look. You can see that there are quite a few configuration options. I've limited it, but there are still quite a few. And these are the ones that are interesting, these ones just up in here. So these are the ones I wanted to validate. And by validate, I mean find the optimal combination of parameters. And it's a very difficult task, or it can be. Okay, so I wanted to do that. Was my primary motivation. And then I wanted, of course, to see if the supply and demand strategy could be automated, and if it could be automated, how well it would do. And so this is where I'm at currently. I can see that, yes, it can be automated. And now I'm in the process of analyzing the results. So looking at the trades individually, the winners and the losers, and trying to understand why it did what it did. And yeah, maybe kind of plan a future for the project, and maybe escalate it in some way so that we can maybe do something, start another project based on that. And thirdly, I mean, I love programming and I like automated trading, so this is my key motivation. This is probably the number one motivation for me to start a course. Super. Okay, so the project rules. The most important thing for me was that it had to be simple. I've had currency strength trading robots in the past, and I mean, currency strength is a pretty difficult beast to harness algorithmically. And so while the results of this project were pretty good, we had about maybe 30% returns over the course of about 3 years. It was exhausting, absolutely exhausting. And so I wanted to try and maybe move away from that and find something that was a little bit better and simpler, and something that you could automate 100%. So the previous version of the algorithm was based on currency strength, and the robot itself would open the trades, and it would it would manage trades to a certain degree, but I would normally have to go in every time I opened a trade. I get an email or SMS, I'd look and I'd kind of analyze the trade after the fact, so after it had been entered, and then make the decision whether or not to leave the trade open or not. And I wanted to kind of go away from that because sometimes it was pretty busy. Although it was indeed trading on the higher time frames, typically the monthly, weekly, and the daily and the 4-hour chart, it did keep me pretty busy. And so I wanted to try and get away from that and introduce a method that could be automated 100% of the time. And then of course I didn't want to reinvent the wheel. And so I have these discretionary tools here, which are really good, very, very good. And I wanted to base it on the same logic that's built into these tools here. And so I didn't want to have to start from scratch. And so I was just using the core, the engine of the other tools I was using, and that was the primary component in this algorithmic trading project of mine. Okay, so if we look at quantifying the most simple rules, so if you look at, the whole list of rules. I have a small whiteboard next to me and the list is pretty long, but there's a lot of talk about parents and children and this accumulation quality checklist. What does that mean? And this stuff is pretty difficult to program if you're trying to make a rule-based program. I think this is a perfect area of focus for kind of deep learning, because there are a bunch of if-thens, and so I think it's an optimal area of focus for using, for example, TensorFlow or other deep learning toolkits or scikit-learn in order to help me with this stuff here. This one here could be programmed, but I didn't want to focus so much on that because this is also something I wanted to validate. I know it works when you apply discretion, but I wanted to see if I could look away from this and focus on other things. Then we have this one, of course, the price consumer posing supply and demand. So when the algorithm identifies an area of supply and demand, what happens there? Can we consume opposing supply and demand? Is that opposing area of supply and demand, is that qualified? Is it a parent? Is it a child? Did it pass the quality checklist? And so you can see the complexity of me having to implement all of these rules, and the other ones that aren't on here is kind of a daunting task, and I really didn't want that. And so I focused on these three here. How far did price go when it left accumulation? And we'll look at these in just a second on a price chart and see what they look like. Then we have, how long did it take for price to get there? And how long, has price been back since the release or departure from the area of accumulation? So if we have a quick look at that, you can see very clearly that if I move this down, we look at the first one, how far did price go when it left accumulation? So if we look at the configuration here, you can see that we have something called a risk-reward ratio. What does that mean? Well, that simply means that we want, once the algorithm has identified an area of, in this case, supply, we know how big it is. So this is, let's say, just for the sake of example, that this is 10 pips. We want the risk-reward ratio to be 3 times that. Excuse me, a cough there. Which means that when price leaves accumulation, it has to move at least 3 times the size of this area of supply. So if we look at that in closer detail, let's mark this off here to here. So we're about 20 pips, so it has to go at least 60 pips, which brings us down to around here. So this absolutely is qualified as an area of supply. And the good thing about this is that it went further. And we had 2 periods of selling pressure. And on the 3rd period, after that one, it started to move back. So this is a pretty interesting area for us here. So this is an easy one to program. Okay, and then we had the different one here. How long did it take for price to get there? So you can see here the price went from, let's mark off the low of the supply here down to here, or rather to here, which is the 3 times that. How long did it take for price to get there? And how can you evaluate that? Well, you can simply look at the number of periods it took for price to get there, and you can see that this happened within one period, so 1 hour of trading. So when price accumulated for 1 hour, as soon as that area of accumulation was finished, price left, and it took under an hour for price to get at least 3 times the size of this area of supply, which is great. This is a really nice departure for me. I like this very much. Then we have the third one, which is, has price been back? And so you can see, I mean, when price leaves, when price comes back up to an area and tests it once and twice, each time price returns to an area, it starts consuming the liquidity available in this pocket of bearish liquidity or supply just up here. So every time price tests into the area, the likelihood of it holding on following tests goes down. And so we want to take the first time back only. And if you look at, discretionary tools, let's see if we can find an example. How you can see this one here, you zoom in, we have this one here, which is a 4-hour area of supply, price left and price is coming back. This is the first time back, but you can see the one just above, it has a dotted box. And this dotted box tells me visually that price has already tested this area of supply. And you can see it has right here, this push back into this area of supply tested this area of supply here. So that tells me that this pool of liquidity here is thinned out, but this one is still untested. And then there's a lot about this whole parent and child discussion, but this is something that I wanted to leave out for this project, because it can tend to get a little bit complicated. And just to reiterate that briefly, what that means is that when price establishes an area of supply, price leaves and it tests it, then it leaves. The reason I use the terminology parent and child, this is to help me assess if there is a relationship between areas of supply and demand on a price chart. So you have this one here, when this is established, when price leaves and price comes back up to that when this happens, when an area of supply is established as a result of another area of supply, well, then there becomes a relationship between these two. And the most recently established area of supply is the child, and the one established previous is the parent. And so you can keep going back, and this simply shows you or tells you something about the relationship between the two and which one was established and at what time it happened. So if you're looking at the kind of chronologically when they were established and a result of which other areas of, in this case, supply. So it can get a little bit, it's not subjective, but it becomes a little bit complicated, I think. And it wasn't going to take me an evening to program. And it was going to, of course, take me more than an evening to program. And I want it to kind of be done very quickly. Cool. So that's done. We have these 3 rules implemented. And if I just show you what they look like here, you can see that we have the risk reward ratio. We have the price imbalance release period. And that simply tells me that I want price to move away from accumulation 3 times the size of the area of supply within 3 periods. So when this period closes, low of this third period has to be at least 3 times the size of this area of supply, which it really is here. You can see if we just measure quickly, this is 20 pips and it went 190. So it's like, wow, it's almost like 10 times the size. So it really did. That's a very, very nice area of, rather, I wouldn't say it's a nice area, but it's a nice reaction, nice release. So we can absolutely see that there was a keen interest in selling at this price level. So that was, that's a very interesting area there. So that was done. It's super easy. And if price comes back to the area, of course, we want the indicator to no longer consider that area for a trade. Let's see if we can find an example. I might go to a different time frame. Yeah, this one here. You can see how this area was established and it's been tested once. This was a beautiful trade. So price was wriggling higher. We had a nice release on the third candle. So 1, 2, 3. So on the close of this candle just here, price was at least, it moved away at least 3 times the size of this area of demand. And the price came back to the edge of the area. And then so the pound Japanese yen was bought at this area just here. And this is a very good example of that. But on the next approach, the robot won't touch it because it's been tested once before. So if they're dotted, if you have a dotted edge on the box, this just tells the indicator that we don't want to go near it. And so you can just watch it and see how price reacts at that level, but it's certainly not a trade that we want to take in the future. That said, this is a nice reaction, and look, when price came down to it, it barely even pierced the upper edge of this area of supply. And so maybe this is one of those few areas of demand that you would that you would trade on the second test, because look what happened on the first test. So if price came back to this area in the future, roughly this area here, or the low of this test, then maybe it might be worth risking 17 or so pips to see if it's going to hold once again. But this is something that's kind of built on my to-do list for tasks in the future. So super interesting there. Okay, so let's look at a couple of examples. I'm just going to run through these one by one. So if you look at this, this is an area of supply that is very interesting. This is interesting because when price rallied and we accumulated we actually have a small continuation pattern between this white candle and this green candle. And you know that because the body of this candle is not within the range of the previous candles. So we have a micro continuation pattern on this one here. So price rallied, accumulated, then rallied. So we had some micro accumulation here, and this is what caused price to move down. And you can see this is reacting to this. What does that mean? Well, that means that this is the child and this is the parent. So the real supply would start roughly here, and it would go up to the highs here, and price has pretty much taken this area of supply out. But looking at this, you might assume that we have some new supply that has entered the market, this area here. So this is a pretty interesting area that we'd consider trading in the future. And you can look here that when price left, we had an attempt to move back to the area of supply. It didn't succeed. On the second one, we came pretty close. We got to the lows of the area of accumulation. Then we saw rejection. And that makes me believe that if price is able to move above this high, if price reacted this aggressively on this test to the vicinity of the supply, I'm thinking maybe on the next test of this supply that will have a similar reaction. Let's see, there's a question here. Carlos is saying another parameter can be whether the initial departure candle of the day demand or supply area has been extended rate candle. Yeah, you see like an extended range candle is often a characteristic of a possible strength weakness in the area. Not all extended range candles should be rated the same. Very good point. So extended range as in the size of the body, you mean in relation to the size of the candle. So this would be a good one because maybe the body of this candle is maybe, I don't know, 70, 80, 90% of the size of the candle. I think this would be classified as an extended range candle, definitely. The white candle is accumulation. And so on the buy side, you have accumulation. On the sell side, you have distribution. So, our broker is selling liquidity to us, so they're distributing liquidity to us. And this distribution is felt on the buy side, so us as clients by our buying. Our buying is consuming, so we're accumulating the liquidity available at these areas. And so a broker is selling to bring price higher, and they're buying to bring price lower, if that makes sense. So they're selling to us, which bring price higher. And this is because when they sell, we buy. Our buying, in fact, makes price move higher. Okay, so this is one example. We have another one here, which is another really nice example. How price rallied, we accumulated for one period, then we had a really nice release, and price kind of drifted lower. We had a lot of green candles, like really nice big moves, moving away from this area of supply. Again, telling us that this is a pretty decent area of supply here at the top. Price came up to the area, we touched it, and price went down. This is probably maybe a 10 or 15 to 1 risk reward. So this is actually a really interesting release just here. Okay, then we have another example. And I mean, that is this one here, how we have this little tiny area, price accumulated for, we had kind of an extended period of accumulation where price accumulated for 3 periods, it left, we came back to the area, and then we left. So you could say that this is debatable whether this is a nice area of demand due to the fact that price has already been back as far down as these lows here. Nonetheless, price came back, we tested this area of demand, and then we moved higher. And if you look left, it makes perfect sense because when price left here, it was actually in the process of returning price to parity, which is on the high here. Is this really noisy because there's a something going on in the street? Hope it's not too noisy. I can jump up and close the window if it is. Okay, and so this was great because when you were buying this, oh, you can't hear it, that's brilliant. So when you're buying at this area of demand, you're buying in the direction of price rebalancing, which is really very important here. So I mean, this is parity for this price move. Price rallied, so price is seeking liquidity. The thicker liquidity is up here, where we have kind of the majority, like the trading that's going on here, and the release to the move, release to the downside, and this is simply trading in the direction of the rebalancing, which I really like. So this is just a beautiful example. But would we trade this on the next approach? No, we wouldn't. Why? Because price moved pretty far into this area of demand. So, I mean, the robot has identified this area down here as the next valid area of demand, and I have to agree with it because we had price came down here, we accumulated for 1 period, and then we left. We had an attempt to move close to it, it was rejected. We had another one attempt to move a little bit deeper. So I'm thinking if price manages to come down here and move below this low here, then I think that we could potentially attract some buying, depending on what's going on fundamentally, of course, because of course the sentiment could change by the time price returns to this area of demand. So that's just three pretty good examples. So I mean, so early impressions and results. Well, when I'm looking at the results, I can see that the entries are generally pretty good. And I mean, my requirement was that it was 100% automated, and it is, which I really like. I like the fact that I don't have to meddle. And so far, the results have been looking pretty good. So let's have a look at the results since the project was launched. And let's have a look here. So we have a bunch of stuff here. I had a trade I lost this morning, and I had this one here, which was a win. You can see a lot of these trades expire. So when the robot opens trades, it sets an expiration, so a number of periods until expiration. So I mean, out of the box, it's just saying after 10 periods, then I want the limit order to expire. And this is simply just to ensure that we don't have orders in the market forever. And I think that if 10 periods have passed, 10 days, 10 4-hour periods, or 10 hours or whatever have passed since the order was put into the market, and if price doesn't return to that area, I'm thinking then it's too late. And so then I'd rather wait and, for example, buy at demand that's closer to price instead of trying to wait for price to come all the way back down, where in the meantime, the sentiment could have changed and price could easily kind of really challenge that area of demand at a later date. I'm just going to move my desk up because the sun's blazing through. And so I added that small parameter just to give me the ability to expire certain orders so they're not stuck in the market like that. Okay, Carlos is saying, do you also take into consideration when the supply or demand area is about to be tested? And better put my power supply on. Good. It's about to be tested in a lower time frame where price is coming from. So often price is bouncing from a higher time frame area of supply and demand, which often should be interpreted as a stronger zone. So much of the overall context is higher time frame structure. Absolutely. So I mean, typically I will not leave this on the small time frame. So I'm not using it on the 15-minute chart. I'm not using it on the 5-minute or the 1 minute. I'm typically using it on the weekly, the monthly, weekly, daily, and 4 hour. I've taken a couple of trades on the 1 hour, but these tend to be less significant, and actually these are I think the losers that I've experienced have happened on the 1 hour chart. You can see this is actually a 1 hour trade, and so I mean, yeah, I mean this might work. You don't know. It's kind of a gamble, but I mean, I like what happened here. I like the picture of this. What I don't like about this is the price has already been back here. And so, I mean, there isn't actually any real demand, supply until we get up to here. I mean, we have some supply kind of here, around here, which has been tested quite a lot of times. And so I'm not very confident that this trade is going to work, but I'm not going to fiddle with it because I need a sample size. So I have to leave the robot alone and let it do its own thing. But you can see, I mean, typically I'll look at the price structure that price is currently hanging on. And we have this one here, and price is hanging on this area of supply. So this is this move down. And until this area has been rebalanced, then this area of supply is still in play. When this becomes balanced, then I do not want to look at this. And I have to look at the next imbalance, which is here, which has been tested a bunch of times. So this has been rebalanced, which brings our attention to an area a little bit higher, just up here, something like this. And this is interesting because price rallied, accumulated, we sold off, we tested the area, and then we had a release. So ideally, I would, using discretionary trading, I wouldn't want to sell for a price any less than the 152.75 here, because price has already been back to this high here on the move down. And so this is kind of just chop, I think, according to the way I like to look at or view supply and demand. So yes, I find it to be much more effective if you're on the higher time frames. So you go to the daily chart. I mean, it's going to find stuff that are in the extremes. And also, one of the beauties of trading on the higher time frame is that if price feeds into an area, these typically aren't taken out quickly. It's not a very quick process. Price will rarely come racing through a daily or a weekly or a monthly supply and demand and just consume it, the liquidity available there, in a couple of minutes. Normally, price will poke into it, will react, will have another test, another reaction, and then it gives me time to go down to the smaller time frames and study micro supply and demand and see what's going on. So assuming this is monthly supply, price is getting close to it, but I'm in no hurry to figure out what it's going to do. But if you look here on the daily chart, you can see, wow, price is really moving higher, and we've closed this gap, and that's kind of all we've done. So we have some supply up here. Around here, we have some supply here. And so, for price to even begin to rebalance this price imbalance, is going to have to move up to at least kind of the lows of this blue candle just here, and maybe even up to the close of the blue candle, the open of the red candle here. And so, the big picture does not support selling here. But if you look on the smaller time frame, we had price rallying. We have some demand down here. It's been tested a bunch of times. Price managed to cut through it. So, okay, let me put this on this so we can have a closer look at it. So, we go on the hourly chart. So you can see we have a small something going on here. So we'll just do it like this. So we had something in here. Price tested it once, twice, 3 times. It's gone. And then you ask yourself, well, what area of supply consumed this demand? And it's this here. This is actually the source of the move that moved through the supply. And so that tells me that we have strength here. But this is not something that the robot knows anything about. This is something that you can gain insight into as a result of studying price, using, for example, these discretionary tools, or just using your understanding of supply and demand and liquidity. The main focus of supply and demand is to bring your attention to a kind of counterintuitive, but something that you're not seeing when you're looking at a price chart, because you can't see liquidity on a price chart. You can see the orders that have been filled on a price chart, but you can't see what you actually need to be able to see when you're trying to trade on a chart like this one here. And so you have to study the way price reacts to these areas of black space or these other periods of accumulation in order to make trading decisions. And so it's people who are making trading decisions based on what they can see on a price chart without perhaps considering what you can't see and paying attention to liquidity distribution. I think it makes it perhaps a little bit more difficult. I'm not saying that it's not possible. I know a lot of people that don't care about liquidity and they're using moving averages and stochastics and stuff, and they're doing really well, and that's beautiful. But I feel, at least for myself, that I feel more comfortable if I'm able to assess the likelihood of an area holding based on the unfolding or the distribution of liquidity, which is going on behind the scenes, which you can't see. Okay, Carlos is saying 3 and 6 months timeframes can also be helpful when looking at structure. Absolutely, absolutely. I totally agree, Carlos. Totally agree. As a matter of fact, the tools that I use, I've written for MT4, and I'm moving away from MT4, and I've developed a version that's based on trading view charts, and it runs in a browser. And I've bought my data from Morningstar in the UK, and it's going to be really, really nice because, yeah, MT4 has its limitations, and so it's very important that that you consider other possibilities, which is what I've done. Okay, super. Okay, so let's have a look maybe at a couple of examples of some trades that it's. You can see a lot of these have been expired. You can see a lot of these expire here. Let's see, the project started, I think it was about the 18th of the month. So, I mean, yeah, about 10 days ago. So it's super early. So let's custom period, and we'll go to the 18th. I did it on the Monday there. I think it was a Monday. Here, the Monday. And so today, it's 20 today. We'll go like that. Okay, and we'll have a look. So let's have a look at the first trade that it did. And it sold here. So it sold here, and it went for about a 2-to-1. This was this area that it was targeting. Price poked into the area. It went down. It came out to retest the area, and then we had that release low. So this was an okay trade. Another thing that is, which I've come to realize 100 times over, is the whole notion of being greedy. Because a robot isn't greedy. The human beings are greedy. And so while I would like to sell here, I'd like to get into the trade to sell here, and I'd like to get out of the trade right down here, it's not going to happen. It's not going to happen. And so you have to be realistic. And so I've just set targets to be 2 or 3 times the size of the risk. Currently, we have 3 times the size of the risk. At the time this trade was taken, this was 2 times the size of the risk. It was $1,000 ago, which makes perfect sense. We're at about $10,000. So $200 is 2%. So that's perfect. But as equity grows, of course, position sizes grow and risk grows as well. So I mean, that was a pretty interesting one. We reacted there. And what did we focus on? Well, we focused on the area, the move away. We focused on how far it went and how long it took to get there. And that's it. So we had this, not a beautiful area. Why? Because we have all of this here. This is much nicer up here, how we had price rally, accumulate for 2 periods, and then it left. So using discretionary tools, you would do something like that. Something like that. So price tested that, and this is where the big move went in. But the robot is not paying attention so much to that. That said, I bet you, if you go to the daily chart or modify the configuration, it'll probably find something else. No, it hasn't. Okay, so I mean, this is an okay trade, but it's not going to go on forever. So take the profits, don't get greedy, and move on to the next trade. Okay, you can see that a lot of these were canceled. This is a lot of testing going on. We had this one here. This looks like a incorrect position sizing calculation. This is on the 4-hour chart. You can see that we have H4, which stands for 4-hour, it corresponds to the buttons here. It was a sell at 146.06. So if we go to the 4-hour chart, I mean, this trade was based on this area of supply just here. So this is the one that did it, and we had 1, 2, 3, 3 candles moved. So price went at least 3 times the size of this area of supply within 3 candles. Okay, then it qualified it. We had the first test, we didn't quite get there. The second test, we went to it. We took the profit, or almost. This is a 1-to-1 I can see, and then price went through, or just under a 1-to-1. And then price went through. Yeah, so this is just a really good example of price tested it once. We got the 1 to 3, pretty close to it. Beautiful. This is technically speaking pretty close to a second test because price has, technically speaking, returned to the area, albeit at the edge here. But yeah, so another interesting one there. If we go higher, you can see we have a lot of these expiring after a period of time. We have this one here. So what's happening here? So we had this one. This is on the 4-hour chart. We're on the 4-hour chart. So this was qualified here, right there. So we had this candle here. I looked at this candle here, or maybe it was this candle here, the high of this candle and the low of this one. So we'll just leave it like that. The stop went just below, and the target was, this looks like a 2-to-1 as well, about 37, so it should be close to 70, yeah, about close to 70. And we hit the target very nicely. And this is beautiful because, I mean, price is moving higher. So if you look at the dollar CAD, we look at this on here with discretionary tools, you can see that we don't have any, we have demand forming below price. That means that demand is strong, supply is weaker. So we have all these areas of supply that are being consumed by opposing order flows. So we have this area of supply up here, which is not very interesting because price has already been back to at least this area here. And so at the time this order was filled, price was on its way back to parity, which is up here. And this is where price bounced. We had a little reaction. Looks like I missed this trade for some reason by a pip or so. So I'll just pull that one off. It didn't get filled. And now price is gnawing away at this area of supply up here. This is a really ugly one. This is nothing. This is not supply. We have something up here like that, which is more interesting. So this is just really nice. You can see price was starting to form some nice areas of demand that were being respected. They were being tested and holding. Supply was being consumed. And this was just a really good idea and a good indication that prices are going to drift higher from here. Then we have this CAD Japanese yen. Where's this one? This is a short at this area here. Yeah, this was a very interesting trade because you can see that this was at a top. And I don't really like that whole picking tops and picking bottoms, but this one worked out fine, and it got out at the extreme, which is kind of a miracle. You can see that, I mean, the low of this candle is 96.38, and this one is located 96.58. So it was 2 pips above it got out 2 pips above the low, which was, yeah, lucky. A very lucky punch. And then price kind of came back to the area, kind of accumulated just below the area. This kind of scares me. If I was watching this, I would be a little bit nervous watching this. This is why you shouldn't watch. You should turn it on and go away. But price comes back and it starts. You see how kind of we poke up, we have some rejection. Every time that happens, liquidity is getting consumed. The next one happens again. Oh, we see some selling price managers to move a little bit low. We have a strong push higher. Price moves a little bit deeper into this pool of liquidity. We see some rejection. The price pushes. We have a really nice deep push. We almost come up to the highs. Then we start to drift lower from there. And now price is having another go. And this, I don't like this here because price is rallying, accumulating. And this is kind of an indication that price is going to give this a good run for its money. And maybe you go for the highs here, which could likely be a reaction to something on a higher time frame. So if we have a quick look, Yeah, so we're reacting at this here, which is an extended period of supply. It's not supply, it's kind of mess. This is where supply is, because this is still untested. Price has not been back here, but this is technically speaking the first time back. First time, so this will actually be the second time back. And so, yeah, this is kind of a lower probability area here. Michael is saying, what are the middle? Okay, I'll just reiterate some of the stuff I just got in there. I mean, so, okay, so about 10 minutes. Okay, so, I mean, I'll go back to explaining the white bars. All right, that's a blow. Okay, so, I mean, the white bars are accumulation. And accumulation is simply orders filling. Did you hear me explain this diagram here? Open, close. You didn't? Okay, I'll explain what that is. Okay, so let's say this is 1 day of trading. This is a daily candle. So when that period opens, price enters the day like so, and it is moving up and down. And price is ultimately looking for liquidity to decide its direction. So price will drift higher. It'll drift in the direction of the thinnest liquidity until it finds thick liquidity that will cause it to potentially move in another direction. So price will drift higher. It'll find a limit order here, and this limit order may or may not be substantial. So it'll feed into here, and this will fill some sell limits, and this will cause price to draw away from the area and move in the direction of the thinnest liquidity, which is now to the downside. So price to the downside is thinner in contrast to the upside. So it'll come down here, and the same thing will happen down here. You have another pool of liquidity here. Price will come down to it, and if this order here is big enough to kind of support price, it'll bounce. Otherwise, price will move through it, and this area of liquidity or this limit order to buy will then be consumed, and it'll move down to the next level. And I always just consider these like a stack of pancakes, where you have a pancake, you have a plate here, like so. Then you have pancakes stacked up on top of them like that. I always use this metaphor because I think it's because I like pancakes, I suppose. And the buying and the selling, these are people with their forks. So this person, he's hungry and he wants a pancake. So if he takes this pancake here, well then the next person that comes along, well then they're going to have to come a little bit further down to get the next pancake. And once that pancake is gone, then that one's going to disappear, and then so on and so forth. And eventually, that's going to be gone, and that's going to be gone. And then we hit the plate, and the plate is not liquidity. There are no pancakes there. And so, as a matter of fact, and so price will have to go down to the next plate, which is a little bit lower, and start gnawing on those pancakes, parentheses, pause liquidity. So the first guy will come along, take that one. So he's the first one. When he's done, the next one will come down, which is a little bit lower. So every time price moves into an area like this, which we'll call a stack of pancakes, every time price pokes into it, it takes away the pancakes, the pool liquidity. And so for price to find an order to kind of cap price, this is simply for price to move away. And so the next level is going to be a little bit deeper, and the next level is going to be a little bit deeper. That's why you see that if you have an area of supply or demand like so, often you'll see that the first test will come to the edge, the next test will come a little bit deeper, the next one will come a little bit deeper, and it kind of goes through like that. And often when it's cut away like that, it's completely gone. So this one is gone. Price will move away, and this is seeking liquidity to do this, to bring price lower. We'll find that up here. So we'll find pancakes up here. We'll just say that they look like that. It'll move up into here, and this will move through this, and we'll start looking for the next one down here, the next pools of liquidity. And the process goes on and on and on forever. So it's absolutely fascinating. I really enjoy that concept. It makes me and other people understand why price moves the way it does. Well, a little bit. We don't really know what's going on, but it makes us feel a little bit more comfortable. Okay, so let's look at another trade that happened, and this was a buy down here, and this is on the Aussie dollar Kiwi, and this is the D1. So this is a daily buy. So this is the area. Price fell off there and moved there, and we got a 1-to-1 just here. And then price went up to probably as far as a 3-to-1 here. And we have another one here. Okay, so these are actually the two. So it's just two positions. So that was fine. Then we had this one here, which is a Euro Kiwi, which was a sell here. So price, we sold here. We went down. We hit the target, and then price kind of went down, came back up. And then it's kind of drifting sideways from there. So that was a 2-to-1. And then what else do we have? And we had some trades today. Let me order these. Let's find those. Yeah, so we had these. These are from today. So we had this one here on the pound American dollar. And this is, what was it? This was a 4 hours. We go to the 4-hour chart and we say, well, what was it there on the 4-hour chart that made the robot buy? So we have a closer look and you can see, okay, what do we have here? Well, we have actually a period of accumulation. We have 1, 2, 3, 4 periods of accumulation. Price went down to here. And this is where it bought. It bought here, price went up there. Actually, I cheated. I took this one off manually because I had a gut feeling that it would go down because price had already gnawed through most of this area of demand here. So price came back. It returned to pretty close to the target. It was pretty close to the target. I've been doing security work today, and I was watching this on my telephone, so I wanted. Yeah, I kept my eye on this. And then we had this one here, which was on the 4-hour. This was a loss, and this was a sell here. And looking in that really clear window of after the fact, you can ask yourself the question. I mean, if you return to these rules, the ones that are grayed out, which are really important when you employ the entire trading model, parent-child, has price been back there, quality checklist of accumulation. This is an epic fail. No. Do not sell. Do not trade. Why? We had this area of supply. It's been tested. It's almost gone. You can see it almost went through it. So this is a parent, and we have a lot of tests. So we have maybe like a macro child here. It's really ugly. It doesn't look good on the higher timeframes. And price has already been back to this level here. And so we'd expect price to come back to at least this level before it turns around. And so, I mean, that was a loss. And I watched that, and it kind of, if we have a closer look on the smaller time frames, price went up, it went down. And then this is I was watching this. I was at a bank doing security work this morning, and I was watching this while I was trying to get things set up. And it poked in here, it came down, and I just watched this kind of happen. This happened, I think it was early this morning. Let me have a look when this happened. This happened at 9. Actually, this happened, what day is it today? Okay, this happened last night. So we got filled last night, and then price stuck around the area. We didn't have a big rejection. Price stuck around, then we started to accumulate. This is a warning sign, because if price is able to accumulate below an area of supply like this, this is an indication it's going to have an attempt to push higher. Because you want to see this, you want to see rejection. When price pokes up into this, if it's not moving away in a hurry, then you don't want to be in there, because there's a pretty good likelihood the price is going to kind of attempt to accumulate below the area and push price high. So the broker is accumulating long orders to move up and through this here. That said, if you consider supply and demand on like the weekly or the monthly chart, then I mean accumulation can take a very, very long time to take place. The shift in supply and demand is generally a pretty slow process. Carlos is saying do you believe that 50% winning ratio is sustainable? Do we need to learn how to make money even when we're winning? The winning ratio is 25 or 35%. Perhaps a system of letting the profits run after taking partial could help offset the losses. You know what, Carlos? I'm glad you asked. I'm going to show you something that's I think is very interesting. Actually, I don't need to do it here. I just need a browser. We're in the process, myself and my partner, of starting a fund in Denmark. And we are recruiting a couple of guys. And one of the guys that we're looking at, so I'm just trying to find, he's doing some pretty interesting stuff. And I just want to show you what he's doing. Okay, here. So this chap, that's a really good question. And I want to show you something. If you look at this, if I can get it on here, if you look at this guy here, he has a win rate of 30%, and it's been down to 26%, which is pretty close to your 25%. And if you have a look here, you can see average win, $10,000, average loss, just under $3,000. And so this is why he can lose roughly 70 to 75% of the time and still be in the green. And this is simply because he's letting his winners run, and he is cutting his losses short. So he's risking on this account a quarter of a percent per trade. And so he's taking at least 3-4 times that for his target. So, I mean, this is seeing is believing, and this is just a really good example of exactly that, where this chap he's not micromanaging, he's putting on, he's not fiddling, he's letting the probabilistic model work its way, and I mean the results are pretty convincing if you ask me. And so no, you don't need to win 90% of the times. I have a customer who has a win rate of like 98%. And he hates losing, and of course, I mean, losing is not nice, but everyone loses, and it's not the end of the world. And so I think that it's completely okay to lose, and you shouldn't expect to be able to win 98% of the time, and most people don't, but you don't have to. And here's just an example of the proof behind that. Good. Okay, so those are the trades, and we're already gone for 1 hour, so I'm just going to slowly wrap this up. Yeah, early impressions, we've been there to do. Yeah, I'm thinking maybe implement some trade management, maybe trailing stops or something else. And I'm also thinking that it might be beneficial to implement some kind of some of the additional areas of focal points for qualifying a really good supply and demand. So this is something that I'm also going to incorporate. But for the time being, this is early days. Maybe this is just a lucky punch. I think for the time being that we'd really need a much bigger sample size, maybe of 100 or a couple hundred trades over the course of a few months, so that the robot has been exposed to varying market cycles, market environments, high volatility, low volatility, high liquidity, low liquidity, and we simply don't have that yet. So that's that. Boom. Okay. So. Yes, Carlos is saying perhaps maintaining a 50% winning ratio in the long run is unsustainable. That's what I mean. Thank you for the presentation. It was very informative. Hey, it's an absolute pleasure. Absolute pleasure. I think if you're scaling out of trades, then you're watering down your winners, and that is a really, really tough. That's a very dangerous game to be in, I think, because then you water down the winners, and so you can have a win rate of 70 or 80%, but still be losing money. And that, yeah, that's I think it's a little bit difficult, very, very difficult. But I think you got some good points there, Carlos. Cool. Any questions before we wrap things up? I know we've kind of gone over time here. I hope you guys didn't miss out too much about what I said. As a matter of fact, I recorded this presentation, and I'm thinking that hey, no worries at all, Carlos. I'm thinking. FX Street, if you want me to send you this video, it has that, because I've experienced that before, which is exactly why I recorded it this time. So I can send you a link to this video, and it's got all of the sound throughout the entire presentation. So maybe that's a good solution to that, and you guys can watch the recording, or at least that bit. Hey, Mike, it's always a pleasure to have you here. You're really good at making these, and I really appreciate your support. It's great, super cool, good, excellent. What do you reckon, FX Street? Do you want me to send that to you? FX Street. I'll send you the link, and you guys can do what you want. Then you can edit it and add your like your watermark and stuff. Okay, cool. But I meant the piece of the webinar where my audio was gone. Anyway, I'll send it to you, and you can do whatever. You guys can make it fit however you like. Cool. Well, if there aren't any questions, yeah, exactly. If there aren't any questions, I think we'll wrap it up. Any last questions before we finish up here? And if you guys want to learn a little bit more about the supply and demand stuff and what we do, you're welcome to come to. You can shoot me an email. My email is, I'll just type it in here. Shah@pipnotic.com. Okay, shoot me an email, Carlos, and we can do it there. And yeah, that'd be perfect. Hey, my pleasure, my pleasure. Right, super. Excellent, good. All right then. Well, I think thank you, Mike and Tom and Pat and Ahmed and Adam and Albert, Carlos. I really appreciate you guys supporting me and coming in here. And thank you, FX Street, as always, for having me as a guest. I absolutely love doing these. You have a really good group, and it's brilliant. Cool. Well, I'll finish up. Thank you all for being here. Thanks, FX Street. Say hi to everyone, and we'll catch you again next month. Thanks, everyone.